Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from the New Zealand Herald on the 30th of April. Reserve Bank wants banks to keep a closer eye on the insurability of properties it lends against. Second topic from interest.co.nz on the 29th of April. ANZ report says Auckland housing market has remained soft despite the recent urge in net migration. Third topic from One News on the 30th of April. Interest rate cuts might have to wait until 2025, economist. And topic number four from Stuff on the 1st of May. The regions where property prices are still rising. Topic number five from the Mortgage Mag on the 1st of May. RBNZ could impose DTIs on mortgage lending from July. So first up this week, topic number one from the New Zealand Herald on the 30th of April. Reserve Bank wants banks to keep a closer eye on the insurability of properties it lends against. The Reserve Bank of New Zealand, the RBNZ, is urging banks to pay closer attention to the insurability of properties used as collateral for mortgages. This increased scrutiny may make it more difficult for individuals to secure mortgages. The Reserve Bank is concerned that if customers struggle to obtain insurance, banks could be left exposed. Insurers are now using more detailed data to assess earthquake and flood risks, causing insurance costs to rise significantly for some policyholders who may reduce their coverage to manage costs. For banks, the risk lies in underinsured or uninsured properties. If such a property is damaged and not repaired, the bank could face a shortfall if the owner is unable to repay the mortgage after a forced sale at a reduced price. The Reserve Bank's worried that widespread underinsurance could threaten financial stability. Therefore, it's urging banks to not only verify insurance at the time of mortgage origination, which they already do, but also ensure continuous coverage throughout the loan term. The RBNZ highlighted these concerns in its biannual financial stability report, emphasising the need for banks to collaborate with insurers to monitor properties' insurance status more closely. In New Zealand, insurers may start offering selective coverage options, allowing property owners to omit certain risks to keep premiums affordable. This could lead to reduced coverage or increased deductibles to save money. Although insurance premiums have been rising faster than inflation, insurance remains generally accessible. However, insurers are becoming more selective in accepting risks. For example, a quarter of online insurance quote requests for high seismic risk areas were declined. Insurers are increasingly adopting risk-based pricing, leading to divergent premium levels based on the risk profiles. Following recent weather events, insurers are passing higher reinsurance costs and building cost inflation onto customers, which is resulting in 23% increase in home insurance costs in 2023. The Reserve Bank of New Zealand anticipates insurers will continue to adopt risk-based pricing to maintain competitiveness, potentially resulting in higher premiums for high-risk policy owners and more attractive premiums for low-risk policyholders. Second topic for this week in review from interest.co.nz on the 29th of April. ANZ report says Auckland housing market has remained soft despite the recent surge in net migration. The latest property focus report from ANZ's economist suggests that the Auckland housing market is expected to remain subdued during the winter months. Analysing Auckland sales data for the first quarter of this year, the report indicates that auction clearance rates and sales to listing ratios point towards a potential softening of the prices in the near future. Despite strong migration inflows into Auckland, the report notes that rental yields have remained stagnant over the past year, suggesting that the region has managed to match rental supply with demand, or alternatively, suggesting that the region has reached the threshold that tenants can afford to pay for rent. This balance, however, does not indicate a surge in investor demand for housing. Auckland's housing supply has seen significant growth, accounting for over 40% of new dwelling consents issued nationally. Much of this new supply consists of multi-unit housing, suitable for both first home buyers and rental properties. This shift in construction activity has helped mitigate the impact of increased migration on rental prices. The report concludes that key indicators of market tightness in Auckland point towards a soft near-term outlook, with the possibility of prices even contracting slightly in the coming months despite the influx of migrants into the region. ANZ, being New Zealand's largest housing lender, provides this analysis within the context of broader national trends. So, my thoughts on this are I suspect that the property market is already turning quite quickly. Just in the last week, we've seen some indications from major lenders that they're no longer taking pre approvals unless the client is currently already banking with that particular lender. Also, turnaround times for pre approvals and loan applications in general is also extending quite significantly because of the number of deals that have gone live recently. So, certainly if you're talking to real estate agents in the area, a lot of the real estate agents are saying what's happened. The market suddenly picked up in activity. People are committing to deals, whereas previously they were just looking and taking their time. If you'd like to learn more about investing in property, feel free to join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, and these deals are available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals, you can also book a no obligation phone call or meeting with my husband, Paul Roberts, via the website. Third topic for this week in review from One News on the 30th of April. Interest rate cuts might have to wait until 2025, according to an economist. Inflation is not declining as swiftly as anticipated by economists, with some suggesting that the next interest rate cut may not occur until 2025. One factor contributing to this is the increase in petrol prices, with the average cost of a litre of 91 petrol rising by 26 cents this year to reach an average of $2.86, according to data from Gatsby. Brad Olson from Infometrics mentioned on the morning report that these rising costs are adding to household expenses. Despite not reaching previous peaks seen after the Russian invasion of Ukraine in 2022, Olson predicts that petrol prices are likely to remain stable or continue a slow ascent, with minimal downward movement expected due to factors such as weaker global economic growth, particularly from China. Olson noted geopolitical tensions as contributing to some price fluctuations, but emphasised that there's little indication of significant relief in petrol prices in the near term. Regarding inflation, Olson questioned who's driving spending in the economy, considering the ongoing economic challenges. He suggested that delayed effects or persistent factors like rising rents and insurance costs may be contributing to these inflationary pressures. There's also speculation that cash-rich baby boomers are spending on bucket list items, impacting inflation. Olson indicated that upcoming unemployment and wage data should provide more clarity on the economic situation. Despite the economic recession and expected rise in unemployment, and with petrol prices remaining high, some economists are questioning the Reserve Bank's aggressive approach to lowering inflation to the 1 to 3% target range. However, Olson argued against changing the inflation target, emphasising the importance of consistency in monetary policy objectives and maintaining public confidence in inflation targeting. Oh, it's going to be an interesting few months, isn't it? I think, in my opinion, I think if they don't cut interest rates before the end of this year, there's going to be some serious blood in the water. So my pick, and this is totally crystal ball gazing, nobody knows exactly what's going to happen. I mean, at the end of the day, even the Reserve Bank makes their decisions at the last minute. But my pick is that there is a lot more pain in the economy. We're just seeing quarterly data results, which is not particularly helpful. And so I think the Reserve Bank is going to start relaxing the OCR sooner rather than later, but time will tell. Fourth topic for this week in review from Stuff on the 1st of May, the regions where property prices are still rising. The national average asking price remained largely unchanged over the past year, decreasing by 0.6% to $868,877, according to new data. However, Central Otago Lakes District and the West Coast experienced significant price increases of over 15%. In April, the average asking price in Central Otago Lakes District was just under 1.6 million, reflecting a 17% increase year on year. Meanwhile, the West Coast saw a 21.6% increase, with an average asking price of 538,752. Realestate.co.nz's chief executive, Sarah Wood, noted that regional variations in pricing and market activity are influenced by local factors and market cycles. Both Central Otago Lakes District and the West Coast have seen price growth alongside decreased new listings. Rising living costs and persistently high interest rates have contributed to reduced demand for property nationwide. Nationally, searches per listings declined by 10.4%, and engagements per listing decreased by 7.5% year on year. Although, as per my previous comments, I think this is changing in the last few weeks, in the last couple of weeks, certainly. Wood attributed this cooling in buyer interest to economic caution prompted by the recession and highlighted the impact of rising interest rates, which are set to affect a large portion of existing mortgages in the coming year. Although the latest information from the Reserve Bank shows that there's a very small percentage now that it's still got to come off those low interest rates and refixing at higher rates. The shift in market dynamics reflects a more cautious approach from buyers, potentially influenced by the anticipated increase in mortgage rates, affecting market liquidity and demand. And last but not least, for this week in review, the Mortgage Mag on the 1st of May, RBNZ could impose DTIs on mortgage lending from July. The Reserve Bank of New Zealand, the RBNZ, has indicated that the earliest it might implement debt-to-income restrictions on bank mortgage lending is July this year, according to its latest Financial Stability Report, the FSR. The Reserve Bank of New Zealand is currently reviewing feedback from its consultation process and plans to announce its decision on DTI and loan-to-value ratio restrictions, or LVR restrictions, by mid-year. Initially, the Reserve Bank believes that DTI restrictions will not impact most borrowers significantly upon introduction, especially as the market is relatively subdued already. The aim of these restrictions is to guard against risky lending practices, particularly in scenarios when interest rates decline, which I think is unnecessary because banks already test affordability at much higher interest rates than what are currently available. Banks are actually really responsible when it comes to lending in New Zealand. So I think the more relevant reason for wanting to introduce this would be to protect people when interest rates are lower from overextending themselves. Like, for example, if test rates were 6.5%, when interest rates are lower, then, that could potentially put people at risk if they need to refix interest rates and interest rates get to levels above that 6.5%, just for example. Despite some modest increases, house prices are said to be within sustainable levels, according to the Reserve Bank of New Zealand. The report also highlights concerns about global interest rates remaining restrictive due to potential inflation pressures, which could continue to strain households, businesses, and the financial system. Regarding interest rates, the FSR notes that most mortgage borrowers have shifted to significantly higher rates, with only a small portion remaining on rates below 4%, as I mentioned earlier. The peak mortgage rate is projected to rise further to around 6.5% before the end of this year. Although higher interest rates have contributed to reduced economic activity and subdued credit growth, the impacts on the financial system have been less severe than anticipated. Mortgage arrears are rising, but are expected to remain relatively low compared to levels seen during the global financial crisis, because banks changed their entire systems following the global financial crisis. While borrowers have adjusted to higher debt servicing costs by reducing principal payments or switching to interest only payments if they were able to, because that requires a whole new loan application, the share of interest only mortgages has remained stable at historically low levels. The report also mentions challenges faced by non bank deposit takers, citing issues related to scale and profitability. Property investing can serve as a hedge against inflation and economic fluctuations, offering tangible assets that can provide stability and financial growth over the years. If you'd like to learn more, join me at one of our free events called How to Succeed with Property Investing. During these 2-hour workshops, I'll cover off recent property market data, and as an experienced property investor and a financial advisor, I'll be sharing valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. And I'll also tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for one of our upcoming events. Alternatively, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. Thanks for listening.